All right, everybody. Thanks for joining us today. We are covering a market update. We did a beginning of the year 2024 forecast. We're getting down to the latter part of the year and wanted to cover some updates and splash in some forecast of what to expect, anticipate for 2025. With that, I'll bring on, we're going to talk about, of course, the lending side of things and the buying and selling, introduce some anecdotal kind of evidence of what's going on. Hopefully it'll be helpful in your search efforts. But with that, we'll bring on our co-host, Chase Hodson. How you doing today, Chase?
I'm fantastic, Jerod. How are you this morning?
Yeah, I'm good. I'm good. Other than I
Good.
got a little bit of sun in my eye here, so forgive the squinting here for a little bit. But anyway, yeah, doing good. I just thought, you were telling me about some of the market shifts we've got, and I figured because we're on the latter part of the year, we just kind of update everybody where we're at and kind of foreshadow what we think is going to come up in 2025.
Yeah, absolutely. Sounds like a good day.
Cool. Awesome. Let me do a couple of just small housekeeping things. For those of you that I haven't met, my name is Jerod Lee. I'm the associate broker and team lead here at My Home Connection, also known as MHC Realty. Our sponsor is the Perfect Home Buying Process. We've been developing this over the last couple of decades. Just want to introduce tools, resources to your overall home buying process, make things easier, cheaper, more efficient for you. We're working with Chase currently in regards to offering up to $500 on the appraisal of your home, as well as up to $500 on the home inspection at closing. But then we're just going to bring a lot of other tools, 100-page relocation and lifestyle guide, insider real estate secrets. We've got a podcast series we'll send you out to bring you a lot of value, educate you on what's going on in the home buying process. So just a lot of good content. Feel free to reach out at any time. And we'd love to have that free, no obligation consultation with you. Other than that, bring Chase back on here. And I thought we'd start again with some anecdotal kind of evidence of what I've got going on the more the buying side, a little bit of the selling side, and then we'd roll into where you're at on the lending.
Okay.
Sound
Sounds
like
good.
a plan?
Yeah, let's do it.
So, for those of you that are looking for a first time home, you've got a couple of options. We've talked about this in prior podcasts. You've got a new construction home, resale home, of which we just have a lot more inventory because it's being created on the new construction side versus resale. We've talked about that a lot of people are just staying put. They've got really great interest rates, and it's going to be tough to move off of that. And I think we're seeing a lot of that, right, Chase?
Yeah.
Just hunkering down.
Yeah, it's inventory. We're seeing inventory creep up, right, as rates were up. But most of that is definitely coming from the new construction side. A lot of the folks that I talk to, a lot of my past clients, if you're in that, 3 or lower rate range, even if you want to move up, they're having a really tough time letting go of that.
Yeah.
And and again, even the ones that do move up, we're seeing a lot of those properties turned into investment homes. It's going to cash flow really good with that low of a rate.
Yep.
So
Yep. Yeah, and we've talked also. We've got podcasts that we talk through how to help assume loans. Obviously, that takes some work, takes some research, but that is an option. So if you're just absolutely wanting to, but you're looking at that low interest rate, and you're like, how do I even match what I've got going on? Though otherwise, it kind of becomes a lateral move because of the increase in
yeah,
interest rate. We can help you look for some assumable loans. Might be an option for you. But one of the things I wanted to share is I'm still seeing promotions from some of the builders.
yeah,
Literally going to get in contract today on 40K off of one of our larger builders here in the valley on a
hmm
just north of a $400,000 home. So if you're on the fence because of this, that, or the other thing, whether it's uncertainty or rates or what have you, to get in a new construction home, fully landscaped, they were even throwing in blinds for at that 400K price point. That's in Ada County. So
yeah, yeah. And I think we'll continue to see that, like we discussed, through the end of the year. Obviously, as um, when we start to see things change in inventory, the inventory levels out, or if we see that a higher demand come back to the market, then we'll see them go away. But end of the year, a lot of the builders want to get those homes off their books, right? So
Yep.
they'll maintain those incentives. I'm
Yeah.
the same way. I had a client that's we went under contract day before yesterday, 20,000, yeah, seller credit on a $350,000 home.
Yeah. Yeah. It's super helpful in minimizing your out-of-pocket cash, right? Because it's less you've got to dig into your pocket for. Of course, rate. We'd all prefer interest rates to go down. Purchase price won't adjust. Interest rate could potentially adjust. Is the mindset that we're typically talking about there. So I would strongly recommend at least look out there, see what's on the new construction front, because I think you're getting some really good deals there.
Still, yeah,
On the first home resale side of things, for nice, in good condition, good, areas, desirable areas, we're still seeing multiple offers. I just had one. We were, potentially going to be the third of three. Um, the kind of homes that are in rougher condition, not as well taken care of, the buying market is super picky, and they will overlook those in a heartbeat. So if you're
interesting.
willing to put in some sweat equity to have somebody come in later, even handyman stuff after closing, market, homes are sitting on the market a little bit. Days are dragging out. They get that stigma of the days on
Yeah.
market. I think you can get a good deal, or at least some really good seller concessions, again, to minimize that out of pocket.
Oh, I like that. That's
Yeah.
good. It's really good to know, and that's always a great option. Gives the client an opportunity, to increase their equity position, pretty quick after closing. So that's
Yeah.
fantastic.
Yeah. Yeah. Absolutely. On the move up market, we're in our market. You're probably talking, six, seven, 800,000 range, depending on where you're looking. We still can see some things moving fairly fast. Again, super desirable, well finished out. Those will go, but you definitely see some home sellers sitting on their home for a little bit. Some being flexible depending on the position that they're in. Some just put it out there, and if they sell it, they sell it. They're
Yeah.
usually able to stick tight a little bit more. They have some resources that if they need, to hold on their home, or do some things on the financing side, that they can. But there's some good deals to be had there as well.
Yeah, the sense of urgency, right, on those move ups is definitely not there. So
Right.
they've
Yeah.
got,
There you go.
yeah.
That's a good way to capture it. Sense of urgency.
Hmm.
And then, of course, you've got more of a hybrid of cash borrowers versus finance borrowers. So cash borrowers aren't as sensitive to where rates are at, or,
Right.
or are going. So cash buyers, they might just move on it, and you might see that changes really quickly because the buyers were financed and they've kind of been on pause, a little slow to remove, but then something triggers the cash buyers, and boom, all of a sudden they're sucking up inventory.
Yeah.
So
Yeah. I still haven't. Yeah. I've have working with some agents that still have a bunch of cash buyers. I
yep.
think they're still a big player in our market currently. So, um, yeah, I don't see as many of those though.
Yeah, yeah, and I think those folks are going to move. If they're at all have that uncertainty, election year type stuff, that's going to come to an end here, very quickly. And
Hmm.
my guess is just by virtue of the uncertainty going away, and that was in the last podcast. What do you do in an election year when you're buying a home? I think that's once the uncertainty's gone, no matter who got elected, the uncertainty's not there,
Yeah.
and they're going to
Right.
jump on it. So those cash buyers are just going to go buying up inventory, which then affects, the ratios, which can affect
Yeah.
you as a home buyer.
For sure.
The other one that I was going to mention is luxury homes. We're talking north of a million, 1.5, and obviously way north of that. But we're seeing those home sellers. New construction, you've got some that have, most, it seems like, are kind of bottomed out of where they're going to go. They're like, hey, I've reduced my price, and it's going to sit there until it goes. Not going to reduce it anymore. You've got others that just haven't moved. They're like, hey, the market's going to rebound. Yes, I've got carrying costs, but I'm just not going to drop my price. Although I think they're going to keep their price, especially if they're new construction,
Hmm.
because it potentially adjusts their comps. I
Yeah.
do think if you are buying and you come in with a price specifically on the seller concession side because it won't ding their sales price and subsequently their comps, I think you can get a good deal. You might not see movement in their listing other than just minor stuff to get a bump in presence online, but I think there's some deals to be had.
Yeah, I agree. As we get to the end of the year, builders don't typically want to carry all this inventory over to the new year, right?
Yeah.
They'd like to get it off their books, and so I think there's always going to be deals to be had at the end of the year.
Yep.
Um, especially this year with kind of what we're experiencing market wise.
Yeah, and some of the national builders, they not only want to get rid of inventory, but they're going to pump their numbers and their status and their overall
Yep.
purchasing power and things like that. That's all, stuff to be taken into consideration, and we can help you understand where that builder's at.
Hmm.
There's a much different way to position you as a buyer with a local, 10, 20, 30 home builder than with a national
Right.
builder. There's different ways to approach those sellers.
Absolutely.
So
Absolutely. So overall, Jared, you're thinking like, what's your overall feeling with our market, top to bottom right now?
yeah, it's strange because it is so volatile. Like one day we'll have a discussion and I'll kind of lean in this direction, and then I'll see evidence of leaning in another direction. But as a whole, I think it just goes back to the basics, and we've talked about this a lot, that we just don't have the inventory. We have
Yeah.
national builders coming in. We have a lot of dirt to be had, but you still got to precede that with
Takes
infrastructure.
time.
So
Yep.
none of that inventory is going to change of any major significance. So meaning inventory is going to stay low.
Yeah.
There is, in my opinion, little to no evidence of demand backing off.
Hmm.
We've still got a ton of reasons to move here, and other states are giving people even more reason to move here.
Right.
And if you just look at those basics, I think if you're a home seller, you're going to appreciate not as much as you did. If you're a home buyer, be aware homes are going to appreciate. It's going to cost more to buy it.
Yeah.
Um, I think that inventory is going to pick up because we do have some national builder presence, and they are going to bring some online, which will help. But I still think the demands are going to outweigh that. And all to
Yeah.
say, we have a very strong, healthy market.
Yeah. Yeah. I would agree. I like that assessment. If you strip all the nonsense away that's going on right now, whether it's the politics or the time of year or the interest rates or whatever, and you just look at it from a supply and demand aspect, it's really hard to see anything different for our little
Yeah,
community.
it's really important to keep your eye on the ball long term. We get caught up in a lot of these nuanced, current market
Hmm.
conversations, but they can just weigh you down.
Yeah.
And unless you specifically tell us you're a short, maybe midterm buyer that really needs to hit it right, and you got to dig into those details. But most people, they're either looking at it from a long term or can transition to a long term play, right? Even if you're, a short midterm buyer and the market just drastically changes, then you're going to have to shift your strategy and say, okay, I got a plan to hold on to this property a little bit longer. Back to our 08, 09 examples, right? All those people that held on to those homes made out very well.
Yes. Absolutely. It may be like you don't know that it really comes down to the term, right? Like how long before you
Right.
realize those gains, but you're going to realize those gains
Yeah.
for sure.
Yeah. So have us help you, look at your current desired strategy, and then, by the way, worst case scenario, if we got to shift a little bit, what does that look like? Can you do
Yeah.
that?
Yep.
So
Absolutely. I agree.
anyway, but yeah, that's just some anecdotal evidence, a little forecasting. We do want to get on the lending side, which kind of spawned this whole conversation. What are you seeing on the lending side other than volatility?
Well, that's yeah, um, yeah, that's what we're seeing. It's interesting because 2 weeks ago we're right on track. Rates are coming down. We're seeing some fives in front of the numbers. Everything's looking good, and then for apparently no reason, it just went the other way, and we've lost probably three quarters of a point over the last week and a half to 2 weeks. So rates have gone back up, more to that high sixes, low sevens range, and it did it in a really quick manner. With not a lot of evidence as to why. So, I mean, obviously, I've got some theories. Everybody has their theories, but ultimately, it's just like we spoke about. It's there's going to be volatility. So the rates are going to continue to trend, but it does not mean that there won't be volatility. There's too much going on around the world. There's too much going on in our country for that volatility not to rear its head.
Yeah.
I mean, so reports came out yesterday. And it's interesting because even the reports that we're getting are very conflicting, right? So they're showing 3% GDP growth, strong sales for September, strong retail sales, but then the Fed also released its beige book which is just kind of an overall, health of the economy, and it kind of tells a different story. And if you speak to uh, corporations, right, and what they're seeing, like one of the guys that I pull information from, they spoke with Starbucks. They're seeing a 7% contraction. Hilton, they're seeing things down, which means like slowing in travel, which means people aren't spending as much money. Volvo is expecting negative cash flow. Some of the large companies around the world are, they're telling a different story. And the data, it gets harder and harder to not just to gather, but to go through and see what the real answer is. A lot of that has to do with the way people work today. I think I don't know, you and I have spoke about this a lot, but I don't know if we have on the podcast before. But during COVID, a lot of the jobs became, everybody started working remotely from home, or from a different state or whatever, and so that affects job openings, whether people are still in the market, like all of that information is much harder to track now.
Right.
Because when a company posts a job, they could post it in 50 states if it's a remote,
Right.
and one job could get counted 50 times.
Yeah.
And so all that stuff, it has to be worked through, and we just haven't had enough time to figure out how to gather all that data properly.
Yeah.
But then we've got the election coming up. And so, like we've talked about, and this is probably the biggest conversation that I've had over the past few weeks is, well, the Fed cut the rate. Why are interest rates going up? Well, the Fed funds rate does not necessarily, it's not a direct correlation to interest rate, to mortgage rates, because the mortgage rates are derived from the bond market, which is mortgage-backed securities and treasury bonds. Mm-hmm. So, depending on how people feel that the election's going to go, or the economy's going, or whatever, is going to affect how they invest.
Yeah.
Where they put their money.
Yeah.
So, ultimately, what we think will happen is as the Fed, cuts the funds rate, then people will pull their money out of mutual funds. Mutual funds are at an all-time high for return, right? Like you're getting 4 or 5% on savings accounts, and so that's a great return for there. But as the Fed, those returns will minimize as the Fed continues to cut the funds rate, and then we expect those people to jump into something that's more, stable, like treasuries or whatever, and so then we'll get that return in the market again. So it's a cycle, it's not just it's never going to be a straight line. So I'm so bullish on real estate though, like still, and obviously people are going to expect me to say that, oh, you're a mortgage guy, you just want more loans. No, I'm buying real estate. Like I'm very bullish on real estate.
Yeah. You're putting your money where your mouth is.
Absolutely. Any opportunity that I get, that I think is either going to cash flow or that I can get a quick turn on, you and I have had these conversations of what I'm looking for and what, we think we should do. So I haven't changed my mind. It is more difficult to get people qualified as the rates creep back up. But what that does is slow the market, like we were talking about seller credits, right? Mm-hmm. The builders given incentives and stuff like that. That means those incentives will drag out longer, which could help you. Maybe use that towards a short-term buy down, or a permanent buy down. There's ways to use that money to benefit you and still get you in the home. So
yeah,
I don't know.
all that's super helpful. Depending on how sophisticated your purchase is. Is it an investment purchase? Is it a personal property purchase? Is it a second home purchase? What does that look like? And you know, as complicated as my mind can get, I've always, as I get older, trying to simplify things as much as I can, because it just means I don't spend a lot of time overthinking.
Yeah.
uh, this is all great information, but I think it goes back to one, what we just talked about, and that is, if things change, can you weather the change? But then your personal situation in the situation.
Yeah.
If you're going to do this, whatever that is, buy your primary, buy a second, make an investment. Um, let's look at the best and worst case scenario and move forward and adjust accordingly. And if things go well, great.
Yeah.
Um, but if you have to do some painful stuff like, hey, it's my first home, I'm not sure about my job, but we've got a second income. Um, you know, I get this. I don't have a lot of cash up front, but these seller concessions are attractive because I'm minimizing my out-of-pocket expense. But
Yeah.
then they're buying down my rate. Am I ever going to see that again? Because I'm not a saver. You know, and then really my only other hope is to get a gift. Okay, so worst case scenario, that negative, I'm not sure about my job, but hey, okay, you had a second income, the wife, the husband, but okay, what if you needed a roommate for a minute? Probably
Yeah.
not the most desirable, but doable. So
Yeah.
I'm just saying, to your point, long term real estate is real estate, right? If you've been in real estate at all for any length of time, you know that there's blips in time that are painful, but for the most part, it's how most people generate their wealth.
Absolutely. The majority of the public.
Yeah. Yeah. And then
Yeah.
factor in your personal situation, and I think you're good. And then all the little, information in between can just be noise.
Yeah. The thing you have to realize, I think the easiest thing is yeah, payments are higher because of where the interest rates and stuff are at, but so is your rent.
Mm-hmm.
That hasn't balanced out either. Rents are higher in this valley than they've ever been. We've seen a little bit of easement nationally, speaking. I don't know if we've really felt that here locally yet, but all of your expenses are up, and I think that's probably what gives people the most pause. Is it's not just real estate that's up; it's at groceries, it's gas pump, it's
Yeah.
everywhere. Right?
Yeah.
We're feeling that inflation. Um, and I think some of the, again, going back to the volatility we're experiencing now, some of that is the Fed chairs have spoke, and they're maybe not gonna they're still gonna cut rates. Everybody's saying they still are supporting that, but they're maybe not gonna do it as quick as they expected.
Mm-hmm.
So the inflation, but ultimately the inflation is going to come down, like it has to.
Yeah.
That does mean unfortunately, with we're probably going to be in a recessive type economy. There will be some job loss and stuff like that, but ultimately that's the balance, right? The
Yeah.
good with the bad, and it'll get us back to a point where we can really grow again. But expenses are up for sure, but if you're making it and you're paying your rent every month, more than likely you can make a house payment.
Yeah. Yeah, the one thing that I think a lot of people miss is the potential volatility in the rental market. If you're
Mhm.
like, hey, I don't want to trade my rent for a mortgage, the one thing to consider is what's the likelihood of your landlord not jacking up your rent? Because as soon as your
Yeah,
lease comes due, you better be entertaining the idea that within a couple of weeks, month, or whatever, they're going to tell you it's 100, 200, 300. I've heard obnoxious numbers, 5, 6, $700 higher.
yep, they keep
That's
going up.
volatility.
hmm Yeah, it is, and you don't get the. I mean, it's a pretty simple equation, right? Like in one of, and I know that we've talked about this, but in one of our, you know, one of the worst economies that we've seen, like as far as real estate goes, um, in the past 20 years, right? And yet we still have a national average of 5% appreciation year over year. So on a $400,000 house, that's $20,000 worth of real wealth that you can build in a year's time.
In a
Where
year.
else do you do that?
Yeah. Yeah, that forced savings account, that's a pretty nice forced savings account.
Yeah, Yeah, most people don't do that on their own. That's why most people build their wealth through real estate.
Yeah. Yep. Yeah. Well, good stuff. We're coming up on the 30-minute mark. I just kind of wanted to get the folks, an update. I was hoping to have some time to go back to the original kind of forecast of 2024, but we all kind of always end up back at the basics anyway. So I'm pretty sure what we talked about played out fairly well. But back to your question about how do I feel about 2025, same as you. The election will be done. People know what's going on. Hopefully, a lot of these things settle out, with wars and stuff like that. But our specific market, I think, if you wait till late 2025, 26, we see some of those seller concessions from the builders, from the resale homeowners, kind of transitioning out, meaning more out-of-pocket expenses. We do. I think you're still in agreement that interest rates we still feel like are going to come down next year, which would
Yep.
help some of that, but that doesn't help your out-of-pocket. So take your pick, which one you want
Yeah.
to go with. So
Yeah, ultimately, yeah, I'm the same way. I'm going to remain bullish on real estate. I think it's a great investment. It's always going to be one of the most solid investments that you can make, whether it's a primary or investment home or however you want to approach it. But that's where I'm going to stay. And yeah, I do. Overall, we do see rates coming down, and there's just too much going on everywhere. But I think what people will need to realize, and what like everybody can get caught up in what's going on, and feel they create these emotions that affect how they spend and how they interact with other people and all that. There's just so much negativity out there through social media and everything. And I think you know you just have to let it go. Like
yeah,
it's going to be what it's going to be. You know what I'm going to do the day after the election, Jared?
what's that?
I'm going to get them to go to work. And that's
Yeah,
what
yeah,
the rest of the world
right,
is going to do, right? Like
right,
nothing's ending the day after. We're
right.
going to get up and go to work. You're still going to have to feed your family. You're still going to have to figure out where you're going to live.
Yeah,
And that's just the best way to approach things.
yeah, yeah. Well said. Live in the moment, enjoy the day, and
Mhm.
if the punch comes your way, just take the punch and suck it up and move on a little bit. But
Absolutely.
so, but we hope all this information is helpful in helping you, make a decision one way or another, or at least another few data points to factor in. And if you have any questions that we can help with, like I said, feel free to reach out for that no obligation consultation. We'll just talk you through your personal situation and specifically how we think going forward in 2025 is going to potentially play into and benefit you, or maybe even hurt you going forward. We'd love to have that conversation. Awesome.
Absolutely.
All right, Chase. Well, thanks again for joining us. Other than that, we'll sign off and wish everybody a blessed one. Take care.
Take care.